Right now, there is a one-page form sitting on the Social Security Administration's website that could put $300 a month back into your checking account. And most retirees only find out about it 2 years too late, after they've already handed that money over. Heads up, quick note. Everything in this video is general information and not personal tax advice. And with that said, let's get into number one, because this one alone could be worth more to you than anything else on this list. Here's the situation. You worked for 40 years. You paid into the system every single paycheck, and now that you've finally reached the age where the rules are supposed to work in your favor, almost nobody actually walks you through what those rules are. Your tax software doesn't flag it. Your pension administrator doesn't mention it. Your CPA files your return the same way they filed it last year and the year before that, because that's what's fast, not because it's what's optimal for you specifically. And in the meantime, the tax code changed. Congress changed it. The IRS updated its numbers for 2026, and most of what changed is sitting there, unused, because nobody told you it existed. I want to give you a real number before we go any further. A single retiree who is 65 or older, who has a modified adjusted gross income under $75,000, is currently eligible for up to $6,000 in a deduction that simply did not exist a few years ago. A married couple, both over 65, can claim up to $12,000 combined. That is not a typo, and it is not a maybe. It is written into the tax code right now, for this tax year, and according to the Tax Policy Center's own analysis, fewer than half of eligible seniors are expected to actually claim the full benefit, mostly because they don't know the income cutoffs, or how the deduction stacks with what they're already claiming. That is one item on a list of 6, and I'm going to walk you through every single one in plain English, with real numbers, so you know exactly where you stand before you file anything this year. Everything I'm about to walk you through comes from 3 sources: the Internal Revenue Service's own published guidance on the One Big Beautiful Bill Act, the Social Security Administration's rules on voluntary withholding and Medicare premium appeals, and the Centers for Medicare and Medicaid Services' official 2026 premium and income tables. I'm not guessing at any of these numbers, and I'd encourage you to pull up irs.gov or ssa.gov yourself while you're watching, just so you can see it's really there, waiting for you. And I want to be upfront about something, because you may have already come across a video or two on this exact topic. A lot of what's circulating right now uses numbers from last year, or the year before that, presented as if they're still current. Medicare premiums change every single year. IRMAA income thresholds change every single year. Even the standard deduction gets adjusted for inflation every single year. If a video quotes you a Medicare Part B premium that doesn't match what's actually printed on your latest Medicare premium notice, that's usually your first sign the numbers are stale. Everything in this video reflects the figures published for the 2026 tax year specifically, and I'll tell you exactly where each number comes from as we go, so you can check it yourself instead of just taking my word for it. Number 1. The Social Security Voluntary Withholding Form, known as Form W4V, and it is quietly one of the most mismanaged forms in the entire system. Here's what almost nobody explains clearly. When your Social Security check arrives, the government does not automatically withhold any federal income tax from it. 0. Not a small amount. 0. Unless you specifically request otherwise. For some retirees, that's actually correct, because if your income is low enough, none of your Social Security is taxable anyway. But for a huge number of retirees whose combined income puts 50 to 85% of their Social Security into taxable territory, that 0 withholding sets them up for a bill every April that catches them off guard. Let's put a number on it. Take a retiree named Walter, 69 years old, collecting $28,000 a year in Social Security, plus a small pension of $14,000. Because of how the taxable Social Security formula works, roughly 85% of his benefit ends up counted as taxable income. Walter never elected any withholding, assuming Social Security was already accounted for. Every April, he owes somewhere between $1,100 and $1,400, and because he didn't pay quarterly estimates, he sometimes gets hit with a small underpayment penalty on top of that. The fix takes 15 minutes. Form W4V lets you choose a flat withholding rate of 7, 10, 12, or 22%, taken directly out of your monthly benefit. Walter picks 10%, submits the form to his local Social Security office or through his online My Social Security account, and from the very next payment cycle forward, his April surprise disappears completely. Here's the mistake that happens just as often in the other direction. Some retirees elected 22% withholding years ago, back when their income was higher, and never revisited it. Now they're retired, their income has dropped, and they're overpaying their federal withholding by $200 or $300 a month, effectively giving the government an interest-free loan they didn't need to give. If you haven't looked at your Social Security withholding election in the last 2 years, that alone is worth 5 minutes of your time this week. And here's the most common mistake of all with this form. People assume they can only submit it once, so they set it and forget it for a decade. That's not how it works. You can change your withholding election as many times as your income situation changes, whether that's a pension starting, a part-time job ending, or simply realizing the rate you picked years ago no longer matches your bracket. There's no penalty for updating it, and no limit on how often you can. Now here's where it gets important, because the same exact logic applies to pension and IRA distributions, just through a different form. Number 2. Form W-4P, which controls federal withholding on pensions, annuities, and IRA distributions. When most retirement accounts are set up, the custodian defaults to a generic withholding calculation that has no idea what your actual deductions are. It doesn't know about your standard deduction. It doesn't know about the additional deduction for being 65 or older. It definitely doesn't know about the new senior bonus deduction we're going to cover in a minute. So it withholds a flat, generic amount that is very often too high. Take Ruth, 67, single, drawing $32,000 a year from a 401k rolled into an IRA. Her custodian withholds at a default 10%, which comes out to $3,200 a year. But once you factor in her standard deduction of $16,100, her additional standard deduction of $2,050 for being over 65, and the new senior bonus deduction of up to $6,000 if her income qualifies, her actual federal tax liability on that IRA income is far lower than what's being withheld. She's loaning the government roughly $1,500 a year for free, money she could be using every single month instead of waiting for a refund next spring. Form W-4P, available free at irs.gov, lets her walk through the withholding worksheet and submit an adjusted election directly to her IRA custodian or pension administrator. Once it's processed, her monthly withholding drops the very next distribution cycle, not next year. Most people stop here, assuming withholding is the whole story. It isn't. The bigger money is in what you're allowed to deduct in the first place, and this next one is the newest, biggest change on the entire list. Number 3, and this is the one I mentioned at the start, the senior bonus deduction, created under the One Big Beautiful Bill Act, available for tax years 2025 through 2028 only, which means it is not permanent and it will not be there forever. Here's exactly how it works. If you are 65 or older by the last day of the tax year, you can claim an additional $6,000 off your taxable income. If you're married and both spouses are 65 or older, that's $12,000 combined. This applies whether you take the standard deduction or itemize, which makes it unusually flexible compared to most tax breaks. Here's the part that trips people up. It phases out based on income. If you're single, the full $6,000 is available as long as your modified adjusted gross income is under $75,000. Above that, it shrinks by 6 cents for every dollar over the limit and disappears completely once your income crosses $175,000. For married couples filing jointly, the phase-out starts at $150,000 combined income and disappears entirely at $250,000. Let's use a real example. Arthur and Denise, both 66, filing jointly, with a combined modified adjusted gross income of $163,000 from pensions, Social Security, and some part-time consulting work. They're $13,000 over the $150,000 joint threshold. Their deduction gets reduced by 6 cents for every one of those $13,000, which works out to a reduction of roughly $780 off the $12,000 maximum. They still walk away with an $11,220 combined deduction. That's real money, and most tax software will not automatically flag this for you. You may need to confirm your age and income situation directly in the software, or ask your preparer point blank, Are you applying the senior bonus deduction under the One Big Beautiful Bill Act to my return this year? If they hesitate, that's worth a follow-up conversation before you sign anything. Here's the part they never tell you clearly, and it's important enough that I want to slow down for it. The senior bonus deduction is completely separate from the older, permanent additional standard deduction that's existed for years for people 65 and older. For 2026, that older additional deduction is $2,050 if you're single, or $1,650 per qualifying spouse if you're married. These two deductions stack on top of each other and on top of your regular standard deduction. So a single 65-year-old with modest income in 2026 could be looking at a standard deduction of $16,100, plus $2,050 for being a senior, plus up to $6,000 more from the bonus deduction, for a combined total north of $24,000 before a single dollar of income is taxed. Most people have no idea these three numbers stack, and most tax preparers won't walk you through the stacking unless you specifically ask. Now let's talk about the one that has the highest single dollar impact per month of anything on this entire list, and it's the one almost nobody understands until it's already cost them money. Number 4. The Medicare Income-Related Monthly Adjustment Amount, known as IRMAA, and the appeal form that fixes it, Form SSA-44. Here's how this actually works, and I want to correct something you may have heard elsewhere, because the numbers change every single year, and a lot of what's circulating online is already out of date. For 2026, the standard Medicare Part B premium is $202.90 a month, not the older figures you might have seen quoted from a year or two back. If your income from your 2024 tax return, the year Medicare actually looks at because of a built-in 2-year look-back, was above $109,000 for a single filer, or $218,000 for a married couple filing jointly, you are currently paying more than that standard amount. The first surcharge tier alone adds $81.20 per month per person, on top of the standard premium, for income between $109,000 and $137,000 as a single filer. Higher tiers climb well beyond that. Here's the trap. Medicare is charging you today based on income from 2 years ago. If you retired sometime in 2024, sold a business, took a one-time IRA distribution, or received a lump sum payout that year, your income looked much higher on paper than what you're actually living on right now. But Medicare doesn't automatically know that you're retired. It just sees the 2024 number and bills you accordingly in 2026. Take Margaret, 68, who worked through August of 2024 before fully retiring, and whose combined income that year, between salary and a small severance payment, landed at $140,000. Because of that 1 year, Margaret is currently paying the second IRMAA tier, an extra $202.90 a month on top of her standard Part B premium. Her actual 2026 income, now that she's fully retired, is closer to $58,000 a year. She is paying a Medicare surcharge based on money she doesn't make anymore and isn't going to make again. The fix is Form SSA-44, a life-changing event appeal, and retirement itself is one of the qualifying events, along with marriage, divorce, death of a spouse, reduced work hours, loss of income-producing property, loss of pension income, and receipt of a settlement payment that temporarily inflated a prior year's reported income. Margaret files SSA-44, documents her current projected income, and submits it either online through her My Social Security account, by mail, or in person at her local Social Security office. Once approved, her premium adjustment typically takes effect within 1 to 2 billing cycles, and in many cases retroactively covers months she already overpaid. For Margaret, that appeal is worth roughly $2,400 a year back in her pocket, and it costs nothing to file. Here's the part they never tell you. You do not have to wait for open enrollment to file this form, and you're not limited to filing it once. If your income drops again for a different qualifying reason down the road, you can file it again. And here's the mistake that trips people up the most with this one. A lot of retirees see the word appeal and assume they need to prove the IRS made an error, so they never bother filing because they don't think anything was actually wrong. That's not what this form does. Form SSA-44 isn't disputing a mistake. It's telling Social Security that your circumstances changed after the income year they're required to use, which is a completely normal, expected part of how the system works. You're not asking for a favor. You're asking them to use current information instead of two-year-old information, exactly the way the form was designed to be used. Number 5, and this one is quieter, but it can cost people tens of thousands of dollars over a lifetime if it's ignored. Form 8606, which tracks something called your IRA basis. Here's the plain English version. If you ever contributed to a traditional IRA with money you had already paid income tax on, meaning the contribution was non-deductible, that portion of your IRA is supposed to come out tax-free when you eventually withdraw it. But the IRS only knows that if Form 8606 was filed for the year the contribution was made. If it wasn't filed, and your custodian doesn't have a record of it either, the IRS defaults to treating every dollar you withdraw as fully taxable, even the portion you already paid tax on decades ago. Take Jean, 70, who made roughly $30,000 in non-deductible IRA contributions over several years in the 1990s, back when his income exceeded the deductibility limits for a given year. Neither he nor his accountant at the time filed Form 8606 consistently. Now Jean is taking required minimum distributions, and because there's no documented basis on file, his custodian reports the full distribution as taxable. At a 22% federal rate, that's roughly $6,600 in tax Jean never should have owed on money he'd already paid tax on once. This also matters enormously if you've ever done, or plan to do, a backdoor Roth conversion, where you contribute to a traditional IRA specifically to convert it to a Roth. Without Form 8606 on file, the conversion can look 100% taxable on paper, when it should only be taxable on any growth, not the original contribution. Most people stop here, assuming there's nothing to be done about old, unfiled paperwork. That's not entirely true. If you have documentation of past non-deductible contributions, even a bank statement or an old tax return showing the contribution, it is worth bringing to a CPA to see whether amended returns or corrected basis documentation can still establish that history going forward. Number 6. And this is the form built specifically with people your age in mind, not general taxpayers. Form 1040-SR, the Senior Tax Return. The IRS designed this specifically for filers 65 and older. It has larger, more readable print, but more importantly, it has a clearer, more direct layout for reporting Social Security income, pension distributions, and the additional standard deduction categories that apply specifically to people over 65. You are allowed to claim every deduction we've talked about today on the standard 1040 as well, but the 1040-SR is structured so those specific line items are front and center, instead of buried in supplemental schedules that a younger filer would never need to touch. If you use a tax preparer, it's worth asking directly, are you filing my return on Form 1040-SR? If the answer is no, ask why not. If you file your own return using software, look for a senior filing option, or confirm your date of birth is entered correctly in your profile, since that's usually what triggers the software to route you to the right version. So here's how all 6 of these fit together, and here's your one action step for this week. Pick the single item on this list with the biggest dollar impact for your specific situation, and handle that one first. If you're currently paying a Medicare premium that feels high, pull up your most recent Medicare premium notice. Check it against the 2026 standard premium of $202.90, and if you're paying more than that and you've had any change in income since 2024, download Form SSA-44 from SSA.gov this week. That single form has the fastest turnaround and the highest monthly dollar impact of anything we've covered today. If Medicare isn't the issue for you, then check your most recent Social Security or pension withholding statement and compare it against your actual tax bracket using Forms W-4V or W-4P. And if none of that applies to you directly, at minimum, do this one thing. Ask whoever prepares your taxes this year one specific question, out loud, before you sign anything. Are you applying my full senior deduction, both the additional standard deduction and the new senior bonus deduction? And are you filing me on Form 1040-SR? That single question takes 10 seconds to ask, and the answer will tell you almost immediately whether your return is being handled the way it should be. Either way, Do not wait until next April to find out you missed something that was sitting there, free, the entire time. If this helped you understand even one thing you didn't know about your own retirement income, that's exactly why this channel exists. So subscribe if you want more of this kind of plain English breakdown of the rules that actually affect your Social Security, your Medicare premiums, and your tax return. And stick around, because next time we're going deep into required minimum distributions and the specific mistakes that trigger IRS penalties nobody warns you about until it's too late.